Hello and welcome to this session on capital budgeting techniques. I am your lecturer, Natalia Francois. And again, today we're going to talk about capital budgeting techniques. Now, when you hear the word capital, you should know we're talking about what the company uses to invest. What money, where do they get the money? Either from bonds, debt, or stocks. And we learned how to value both stocks and bonds. Now we're going to look at different techniques of budgeting these capitals. Just an overview of capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing the owner's wealth. Now, if you remember, maybe it's the first session, we talk about the goal of the firm is to maximize, the shareholders' wealth. A capital expenditure is an outlay of funds by the firm that is expected to produce benefits over the time greater than 1 year. So capital expenditures go beyond 1 year. It's funds that is invested in a company to generate income, generate profits greater than 1 year. Operating expenditure, now it's different. These outlay of funds that is used in a company. The benefit will only be received within 1 year, right? So capital is greater than 1 year. Operating, it's just 1 year. The capital budgeting process consists of 5 steps. So let's say you're in a company, you're a manager for a company, you're HR director, and you have an idea or you want to use a HR system to manage employee records, absentees, vacation, that sort of stuff. How do you go about requesting the funds, getting this project in place? A proposal generation. So the first thing is a proposal for the new investment projects are made at all levels, right, within the organization and are reviewed by the finance personnel. So your proposal is then submitted to finance. There's a review and analysis done. So the financial managers, they perform a review and analysis to assess the merits of this investment proposal. Then they make a decision. Decision making, the firm typically delegates the capital expenditure, right? Because they're saying that this expenditure is going to bring in flows, cash flows, money into the business over a period of time, more than 1 year. Implementation, and followed by approval, expenditures are made and the projects are implemented. Expenditures for large projects often occur in phases, so like different times of the year or different years. Follow-ups. Normally with capital expenditure, there should be a follow-up, results are monitored and actual costs and benefits are really compared, what's the actual costs and the benefits with those that they had expected, right, from the proposal. Action may be required if actual outcomes differ from the projected ones. Now, just some budgeting technique terminology. We're going to talk before we go into the actual techniques. Independent and mutual projects. So independent projects are projects whose cash flows they're unrelated or they're independent of one another. The acceptance of one does not eliminate the others from further consideration. So it may be different departments have projects. Those will be independent. They're not dependent. So if HR has a project, marketing have a project, accounting have a project, the firm is not going to decide to take one, right? So each one will be considered. Then you have mutually exclusive projects. So are projects that compete with one another so that the acceptance of one eliminates from further consideration all other projects that serve a similar function. So the example of an HR company or HR department wanted to have maybe a software. If they have several software designs, those those will be considered as mutually exclusive projects. So they're selecting one. The others will be eliminated after they select the one for consideration. You have acceptance, rejection approach. This is the evaluation of a capital expenditure proposal to determine whether they meet the firm's minimum acceptance criteria. Right? If it meets that, it's accepted. There's also the ranking approach, so they can choose which project on a basis of whatever predetermined measure or rate of return, whatever ranking, it will be selected. Now, with capital budgeting techniques, here's we have an example. Bennett Company is a medium-sized metal fabricator that is currently contemplating two projects. Here's Project A. Project A requires an outlay, an initial investment of $42,000 and Project B 45. The relevant cash flows for the projects are presented in the next table and the timeline. Right, so here's what is happening. Project A and Project B. Project A is costing $42,000 and Project B is $45,000. Within 1 to 5 years, this is the cash flow that will be generated from this project. So it's a fabricating company, so let's say it's an equipment, a piece of machine. This is the amount of projected cash flow for 5 years. Projected cash flow for 5 years for Project B. Maybe it's another equipment, right? You're the manager, finance manager. Oh, you may be the manager who's proposing the projects. Which one would you accept? Right? It's not so easy for you to say A or B because they all equal the same cash flow, right? But which one would you say? So this is what we call capital budgeting technique. So we're going to do the first technique. The first technique is called the payback period method. Now, this is the amount of time. So when you hear payback, this just means the amount of time is considered required for a firm to recover its initial investment. So the initial investment is equal to the cost of the investment as calculated by the cash inflows. So the length of maximum acceptable payback period is determined by the management. So if the payback period is less than the maximum acceptable payback period acceptable payback period, we accept the project. If it is greater than the maximum, we reject the project. So let's put it into example. We can calculate the payback period for Bennett Company's Project A and Project B by using the data from Table 1, which is the same data. If Project A, which is an annuity, because we see there's constant flow each year, 14,000, the payback period is 3 years. How did we get 3 years? 42,000 initial costs divided by 14,000 annually. Now let me take you back to the table. Right? So it's 14,000 for 42,000 initial costs divided by 14,000 give us 3 years. So it basically means in 3 years it will take to cover the initial cost. So that's payback period. What about Project B? How long will it take? Sorry about that. Oh. Because Project B generates a mixed stream of cash flow, the calculation of its payback period is not as clear-cut. So in year 1, the firm will recover $28,000. On the table, we see that. So it's year 1. 28,000 of the 45. Year 2, it covers 40,000, which is 28 from year 1 and 12 from year 2. So far in year 2, it has covered 40,000. But what's the initial cost of Project B? Project B initial cost was 45. So we're still missing 5,000. So at the end of year 3, the $50,000 will have been recovered. So we only need $10,000. 50% of year three's inflow of $10,000 is needed to complete the payback period of the $45,000, right? So at the end of year three, the project would have had 50,000, 40 plus 10. But we don't need 50, we just need 45. So we're only taking 50% from year three. So the payback period for project B would be 2.5, which is the 28, from year 1, 12 from year 2, and then we're taking 5 from year 3, right? So it's 2.5 years. Now we have two projects. We showed you we have two projects. One took 3 years and one took 2.5 years. Now if we have to select which project should we take, we would accept project B because it pays back we get back our return of our initial investment sooner than later, right? So project B would be accepted under the payback period. Just some pros and cons of payback period. The payback period is widely used by, it's a large firms to evaluate small projects and by small firms to evaluate most projects. Now, its popularity results from its computation simplicity. It's very simple. By measuring how quickly the firm recovers its initial investment, the payback period also gives implicit consideration to the timing of cash flows, which we're really concerned about, and therefore the time value of money as well. Because it can be viewed as a measure of risk exposure, many firms use the payback period as decision criterion or as a supplement to other decision techniques. The weaknesses of the payback period, however, is that the appropriate payback period is merely a subjective determined number, right? Because remember, the cash flows are estimated. It cannot be specified in light of the wealth maximization goal, right, which is to return to the shareholders, a profit, because it is not based on discounting cash flows to determine whether they add any value to the firm. A second weakness is that this approach fails to take carefully into account the time factor of time value of money. And the third weakness of the payback period is that it's failure to recognize cash flows that occur after the payback period. So what happens to all the cash flows that come in after? It may come in more, but it's not taken into consideration. Here we have a personal finance example. Seema Mahedi is considering investing $20,000 to obtain a 5% interest in a rental property. Seema is in the 25% tax bracket. To be acceptable, so if Seema decides to accept this project, she requires the investment to pay itself back in terms of after-tax cash flow in less than 7 years. So her expectation is that she's going to get back her $20,000 after tax in less than 7 years. So let's see what's happening here. Her real estate agent conservatively estimates that Seema should receive between $4,000 and $6,000 per year, right? That's an estimate, in cash from her 5% interest in the property. So she's getting a 5% return. Seema's calculation of the payback period on this deal begins with the calculation of a range of annual after-tax cash flow. So after-tax cash flow is normally 1 times the tax rate times the pre-tax cash flow. Tax rate is 25%, 1 minus 25% times the $4,000 range. Her cash flow could be $3,000. 1 minus 25% by 6,000, her cash flow range could be 44,500. So let's start look at it. Dividing the $20,000 initial investment by each of the estimated after-tax cash flow, we get the payback period. Right? So if she's getting $3,000, because we took out the tax, right? We took out the tax from her estimated cash flow, which was 4,000. We got a tax of 1,000. So after taxes, 3,000. After taxes, right? 45. So 3,000 divided by $20,000 gives us 6.67 years. 20,000 divided by 45, if the cash flow is 45 after tax, it's 4.4 years. Now, if you remember, Seema, she wanted the project that would give her less than 7 years, right, to pay back. So because the Seema's proposed rental property investment will pay itself back between 4 to 6 years, which is the range below her maximum payback period of 7 years, the investment is acceptable. She will accept it. But this is how she determined, right, based on her 7-year payback period, if she can get back the returns from her initial investment, she's going to accept it. We have two projects here with the same price. Diamond Enterprises, small medical appliance manufacturer, is considered two mutually exclusive projects named Gold and Silver. The initial project is $50,000 each, and these are the returns. When we measure the payback period, we can see it takes 3 years for each one. Right? So looking at project Gold, 5 and 5 is 10, and 4 is 50. It covers it in 3 years. Project Silver, we have 40, and 2 is 42, and 8 is 50. So using the payback period, both projects give us 3 years. So what will we do? Let's look at another capital budgeting technique called net present value. Now, the NPV, for short, is a sophisticated capital budgeting technique found by subtracting the project's initial investment from the present value, right? From the present value of the cash inflows discounted at the rate equal to the firm's cost of capital. Now, NPV, present value of capital inflows minus initial investments. That's how we calculate it. The present value of cash flow minus the initial investment. Now, we did cost of capital in the last session. So, decision criteria. If the NPV is greater than $0, we accept the project. Right? It's not negative. If it's less than 0, or it's negative, we reject the project. So if it is greater than 0, the firm will return it greater than its cost of capital. Let's look at another example. Why is it shifting, I guess? Let's look at the data from the first company when we looked at the payback period. So we'd see which project should be accepted. So if you remember, project A was 42, project B was 45, and these are the cash flows. So using the NPV, where we discount the present value of cash flows and minus it from the initial cost of capital. It's a timeline representing the discounting factors over the 5 years. Using our calculator, well, the online calculator won't be able to do this, but if you have a finance calculator, they show you the functions to use, right, to calculate the net present value. So the net present value for project A is 11,000, and project B, the net present value is 10,924. Now you can do it in Excel. So let me show you or demonstrate to you how we do it in Excel. So we have here the cost of capital was 10%. Well, that was given to us. If it's not given, then we know how to calculate it. 10%, project A, project B. Now we have here 0 or the end of the beginning of the end of the year, our initial investment was 42,000, right, for project A and project B. And then our cash inflows for the 5 years at the end of 5 years goes as follows. So how do we calculate the net present value? This is the formula we put in here, right? I will share this with you. So we put in the formula. Excel has the function to calculate net present value, and we found the net present value to be $11,071, same as the calculator. And for project B, 10,924. Now, which net present value is better or bigger, higher? Project A. So our project to be accepted is project A. There's a formula for that as well, if we had several different projects to look at. Now, net present value and the probability index is an index that is sometimes used for a project that has an initial cash flow followed by cash inflow. The profitability index is simply equal to the present value of cash flows dividends by the initial cash outflow. And that's the formula there. When companies evaluate investment opportunities using the probability index, the decision rule they follow is to invest in the project when the index is greater than 1. Now here we have the net present value of the project, the net present value, the cost of the value of the cash inflows from, the present value of cash inflows for the project, right, A and B, to calculate the PI for each of Bennett's investment opportunities. If you go back to the timeline, you'd see the figures there. We divide by the initial cost, and the PI is 1.26. So again, project A will be accepted using the profitability index. Now, net present value also has another addition to it called economic value added, which is a registered trademark of the consulting firm Stern Stewart and Company. The EVA, sometimes called method, begins the same way that the NPV does, by calculating the project's net cash flow. However, the EVA approach subtracts those cash flows, a charge that is designed to capture the return on the firm's investment demand on the project. Now, EVA determines whether a project earns a pure economic profit, a profit above and beyond the normal competitive rate of this line of business. So suppose a certain project costs $1 million upfront, but after that it will generate net cash inflows each year in perpetuity. So in perpetuity mean each year, yes, until of $120,000. If the firm's cost of capital is 10%, then the project NVP and net present value and EVA are calculated as follows. So the net project value, because it's constant, you just divide the 120 by the 10%. So the net present value will be 200, and EVA will be the 120 by the cash inflows minus 100,000, which is 10% of the initial cost, and the EVA is $20,000. Now, the next capital budgeting technique we like to use is internal rate of return. When I say we like to use, because I'm in finance. Finance personally find them using this more. It's a discount rate that equates the net present value of an investment opportunity with 0, because the present value of cash flows equal the initial investment. It is the rate of return that the firm will earn if the investment in the project and receives the given cash inflows. So here's your formula here. But again, thank God for Excel or these calculators. We don't have to put in the formulas. We use the tools that are available to us. So in selecting the project based on IRR, if the IRR, internal rate of return, is greater than the cost of capital, well, in our case was 10%, we accept the project. If the IRR is less than the cost of capital, we reject the project. Now, these criteria guarantees that the firm will earn at least its required return. That's why we like to use it. Such an outcome should increase the market value of the firm and therefore the wealth of the owners. So we would have completed our task. Just the timeline I will generate. So at the end of the cash flow, so when we do receive all our cash flows, we know the net present value brings it back down to 0. So IIR brings our cash flows back to 0. So to find the IRR using the pre-program function in the financial calculator or Excel, I will call it, right? I won't explain that because we don't have the calculator. Comparing the IRR for projects A and B, let's look at it on the Excel sheet. This is the Excel sheet. Again, let me demonstrate it. So IIR we list out project A and B, outflow and inflows. IIR is simple, the function IIR, and we select the cells of the cash inflow outflow. Most simple. And it gives us 20% and project A and 22% project B. However, project B is accepted because it carries a higher cash flow. Now, all the time we have been seeing project A. Now, well, payback period we got project B, payback net present value we got project A, and now for IIR, internal rate of return, we're getting project B. Let's see some of the differences. Right, so this is the results, right? So this conflict, so they round it off, right? We round it off. This conflict with the NPV rankings obtained in an earlier example, right? Such conflicts, right? It's conflicting because payback period, we got project B, NPV, we got project A, and now IIR, we're getting project B. Now, such conflicts are not unusual. There is no guarantee that the net present value and the IIR will rank projects in the same order. However, both methods should reach the same conclusion about the acceptability or non-acceptability of the projects. To demonstrate another example of the IIR before we look at the differences between the two, let's look at this example. Tony Di Lorenzo is evaluating an investment opportunity. He feels that this investment must earn a minimum compound annual tax rate of 9% after tax return. So here again, he wants a 9% return on his investment. Tony's initial investment would be $7,500, and he expects to receive annual after-tax cash flow of $500 per year in each of the first 4 years, followed by $700 per year at the end of 5 years through 8 years. He plans to sell the investment at the end of 8th year at $9,000. So I'm going to plug these figures into an Excel. So the initial investment is $7,500. For the first 3 years, first 4 years, it's $500. And the next 4 years, it's $700. Plus $9,000, which he plans to sell it for. Now, using the IIR, initial rate of return, what is his rate of return? Would it be greater than 9% or less than 9%? At least we want it to be greater than. So again, you plug in the figures and you use the IRR function in Excel, and we select all the cash flows, outflows, and inflows, and it gives us a return of 10%. This Excel is rounding it off, right? So we'll see it is higher, it's much higher than his expected after-tax return, right? His expected after-tax return was 9%. It's higher, right? So given that it is above 9%, the project would be accepted. Now, these conflicting rankings are conflicts in the ranking given a project by NPV and IRR results from differences in the magnitude and timing, right? So it's just because of the magnitude and the timing of cash flows. Take note of that. One underlying cause of conflicting rankings is the implicit assumption concerning the reinvestment of intermediate cash inflows. Cash inflows received prior to the termination of the project, when they received it, how long they take to reinvest it. Now, the net present value assumes intermediate cash flow are reinvested at the cost of capital, while IRR assumes that they are reinvested at the IRR rate. And remember, we said once the IRR is more than the cost of capital, we accept. So this sometimes results in the differences. A project requiring a $170,000 initial investment is expected to provide cash flow of $52,000, $78,000, and $100,000. The net present value of the project at 10% is 16, and at IRR it's 15. Right, the table generates it, right, assuming a 10% of capital. Again, let me show you how it's done in Excel, and again I will share the sheet with you. So we have the cost of capital 10%, and we have the cash flows from the project using the function net present value. We find it to be 16,000 and the IRR to be 15%. 15% is more than the cost of capital of 10%, right? So we say it's a good project, unless we're comparing it with another one. But if we're not comparing with another one, at least we know it's covering our initial cost, our cost of capital, sorry. If the future value of each case in Table 1, 10.5, were viewed as a return received 3 years from today from the 170 investment, then the cash flows would be those given in Table 10.6. Right, so we just calculated that. Another reason why the IRR and NPV methods may provide different rankings for investment options has to do with differences in the timing of the cash flows. When much of project's cash flows arrive early in its life, the project's NPV will be particularly sensitive to the discounted rate. So remember, you have 12 months in the year. If the cash flow is received in January as opposed to November, it could affect it. On the other hand, the NPV of projects with cash flows that arrive later will fluctuate more as the discount rate changes. The differences in the timing of cash flows between the two projects does not affect the ranking provided by IRR. IRR doesn't deal with that. Don't touch. So from the rankings we can see, as said before, the IRR method, project B was selected. Project A, if IRR is less than 10.7, project A was selected. If it's greater than 10.7, then project B is selected, right, based on cost of capital. Now the scale comparing the NIV and IRR. The scale problem occurs when two projects are very different in terms of how much money is required to invest in each project. In these cases, the IRR NPV method may rank projects differently. The IRR approach may favor small projects with high returns. The NPV approach favors the investment that makes the investment the most money. So you can decide which one to use, right? So they're saying IRR may favor smaller projects with higher returns, and NPV, they favor investments that makes the investment with most money. So none is really wrong, or none is really better, right? On a purely theoretical basis, NPV is the better approach because NPV measures how much wealth a project creates or destroys if the NPV is negative for shareholders. Certain mathematical properties may cause a project to have multiple IRRs, more than one IRR, resulting from a capital budgeting project with non-conventional cash flow patterns. The maximum number of IRRs for the project is equal to the number of sign changes in the cash flow. Despite its theoretical superiority, however, financial managers prefer to use the IRR approach, right? As I said earlier, just as often as the NPV method because of preference for rates of return, right? But none is wrong, both are very good. Just a matter of fact, which methods do companies actually use? Because I know somebody in their mind is saying, which is better, overthinking it. A survey of CFOs, they say that they use 76% use IRR and 75% use NPV. Right? These techniques enjoy wider use of larger firms with a payback period being more common in smaller firms. Now you can take this whole example and put it into context of your type of investment as you go forward in your career and in your making personal investments. Just a little on ethics, non-financial considerations in project selections. Non-financial considerations. So most companies, ethical considerations are primarily concerned with the reduction of potential risk associated with the project. Right? So sometimes the risk is involved. Another way to incorporate non-financial considerations into capital project evaluation is to take into account the likely effect of decisions on non-shareholder parties or stakeholders, employees, customers, local communities, and suppliers. What are the potential risks to a company of unethical behaviors by employees? What are potential risks to the public and the stakeholders? So it just means that you may want to select a project based on the best NPV or IRR, but there may be some other considerations, especially if it has to do with ethics, that you may not select that project and you may choose to select the lower project with a lower NPV because of these other non-financial factors. Right? So it's not just concrete, that's the highest we're going with it. We may need to take into consideration how it impacts the risk. And this is the end of the session. Thank you for viewing. See you in the next session.